Give an overview of what we're going to discuss today. So today we're going to be talking about different real estate investment strategies. These are top five that I really specialize and focus on with a lot of my investors. It's not the only five real estate investment options that we have, but it are the most commons. And I chose this specifically because of the market that we are in right now. And it is what I do most common. And I know it's probably some of the most common questions that I get as well about all these five different types of investment options and how to get started, how to finance them, etc. So that's what you're going to be learning today. Different diverse strategies for smart real estate investment in this moment, at this juncture, that are adapted to each specific investor profile. So every option for each investor is different, and it's going to depend on their strategic goals and strategies. Well, a little bit about me for the ones that are not familiar with who I am. I am Tony Valdes, and I have over 25 years of experience in banking and finance. And I worked for major banks in the United States like JP Morgan Chase, PNC, Bank of America, Synovus Bank, along my career. I am also a seasoned real estate investor. I have done fix and flips. I have managed and bought and sold long-term rentals, managed an Airbnb portfolio of about 30 properties at one point. And for disclosure purposes, I am licensed mortgage loan officer. I am also a licensed real estate agent and a property appraiser in multiple states. So that positions me in a very unique way to be able to see every investment option from all different angles, even if I'm not doing all the services at one time for the client. So I can advise you not only for the right type of financing, but also the transaction itself overall. We're going to get started today. Typically, I start with a real estate market update. And kind of like what I'm going to be focusing on here are the two or three main things that are happening in the industry right now, okay, that are really going to have an impact. They're already having an impact in the investment real estate market, but also is going to be coming up in the next few months and in the next year for sure. And that is number one, everyone is aware of what the Federal Reserve rate decision on September 17, when the Federal Reserve decided to start lowering the rates. And I'm going to speak a little bit about what's happened since where we are at today. Actually, we just had some economic data today about jobs, and it has implications in what I'm discussing here right now. But the main decision for the Federal Reserve in reducing rates and projecting more cuts into the future all the way until December and further, possibly easing the mortgage credit and increasing housing demand normally in a regular market. But we're not in a typical regular market. We just came off of inflationary markets where there was a lot of liquidity for the last 3, 4, 5 years after the COVID pandemic, which is not natural. That was all induced by a lot of printing on the money. So now we're going to see the reverse start to happen. And basically, the Federal Reserve typically has two mandates. Maintain inflation. Typically, they look for an average about 2% inflation annually, and maintain highest employment possible. Right? So those are two difficult things to do at the same time. And right now, we're starting to see that the inflation has come down overall in the last year and a half or two, compared to where we were at during the pandemic, but it's still way above levels that the Federal Reserve targets. So the other part is a maximum employment. The economy has enjoyed maximum employment for the last 4 years, historical highs as far as employment, but that's starting to change. And today's number will indicate that the economy added 119,000 jobs, but in reality, when you look at the unemployment rate, it actually ticked up from 4.3 to 4.4. So what does that mean? That the economy is slowing down. So not necessarily because of the rates are going down or the Federal Reserve's indicating that the rates are going down, it's going to really mean a recession, right? But there is a possible recession if we're not already in one, and there is a consumer crisis. And what does that mean? It means, the consumer is feeling the pinch of not only high prices, but also it's a historical debt compared to, the last 30 years, for example, in credit cards, auto loans, and other consumer debt. So what does that mean? We're in a 70% consumer economy. Okay, so everything, most of the GDP of the country, about 70% comes from consumer spending. So if consumers are not spending, typically that's going to slow down the economy, and normally it reflects into a recession. Okay, now this time, like all times in my experience, it could be different. And what does that mean? Well, when you add the typical ongoing reshoring and economic structuring that the administration is currently embarking on with tariffs and economic restructuring, that will have an effect on the economy. So most likely, either we already are, like I just mentioned, or we will be soon in an economic recession. What does that mean, and what key strategies to take in consideration? Well, there are, strategies that is specific for real estate investment that you can utilize to not only prepare, which is what I have been teaching since April, but also take advantage of some of the opportunities that presents into the market. And that is typically a smart financial strategies. Okay, if you are going to invest anything in real estate right now, definitely got to have the right financial product, the right financial structure. Make sure that we're looking at properties for that has cash flow. Okay, if you're looking to keep the properties either for long-term or short-term rental, we're going to talk a little bit more about that in a moment. Take advantage of pricing discounts right now. This is a buyer's market, and maintain liquidity and diversification. Do not get married with just one strategy, because that's usually how investors could get burned. So, but it will present opportunities, and didn't want to leave this one behind. With the Need Build Beautiful bill, this presents great opportunity for real estate investors. And the government is now incentivizing, and the IRS is going to start incentivizing starting now in 2025, where if you start investing in real estate and you start renovating properties and keeping those properties, you're now going to be able to take advantage of accelerated 100% depreciation again, something that used to be a few years ago and went away. But now, what does that mean? Well, if you're keeping rental properties into your portfolio, you're going to be able to depreciate up to 100% of the value in the first year to be able to compensate for other tax bills that you have to pay. Again, I'm not a CPA or a tax advisor. Talk to your CPA or advisor, consult your accountant about this. But this is general information in the market, and many of my clients are starting to take advantage of this opportunity. Not only are you going to be able to do 100% depreciation on the first year, you're also going to be able to take advantage of renovation costs as credits towards those rentals or those flips. So make sure that you're taking advantage of that, and talk to your accountant, depending where you're located, to take advantage of that. The reason that this bill passed is to us, help encourage more purchases and rehabilitation for inventory in the market, especially for first-time home buyers. But it also creates an opportunity to start building a portfolio of rentals, okay, or even multifamily properties and large renovations. So this is a game changer. It's passed up for 5 years, so make sure you're getting aware with your accountant and take advantage of it. This is what we're going to be covering different types of investment right now today. And I broke it into two sections. The different types of real estate investment that most of my clients are taking advantage of right now. And it's really going to depend on what kind of investor are you. I broke it into two different types: active investor or passive investor. If you're an active investor, the real estate investment strategies typically fall within this category. Again, these are not the only ones, but it is some of the main categories that most of my investors are interested in investing or financing, and the most common as an active real estate investor. Number one, fix and flip. Okay, where you can buy renovate, sell, or buy, renovate, and refinance if you want to keep a portfolio. Short-term rentals, those are the typical Airbnbs with active management. Okay, that means you're actively going to manage these properties yourself. And again, these are a different type of active real estate investment, not your typical long-term rental, where you just put a rental for 1 year lease and you don't have to worry about until renewal. Short-term rental typically going to be active daily, basically, and but it does give you a higher cash flow. New construction. This is a more active investment right now in this moment, especially since builders nationwide are slowing down in their investment in new inventory. So it is allowing small, medium-sized investors to come into the market and fill in that gap for new inventory for first-time home buyers or for the rental market. But it is an active real estate investment. You do have to work with a crew, not only in the construction, but also in the sale or the rental after. The second category of passive real estate investment strategies fall under the typical long-term rental. You can also fall here under the short-term rental, but with property managers. So basically, it's not actively managed. You're going to have a property manager or someone is going to take care of the maintenance and the active management of that Airbnb. It could also be turned into a passive real estate investment strategy. And the second one is multifamily properties. These are not the typical single family rentals. These are properties that have at least 2 to 4 units or 5 units or more. And normally these are more passive because you're going to have a property management company that is going to take care of it, all the maintenance, all the anything that has to do with the active management of that property. So I'm going to break it down a little bit more by each category to give a little bit more background on each type of investment and some of the most common mistakes that people make in each type. And I'm going to start with the fix and flip. Okay, this is a very popular strategy that I use with my clients on a daily basis, and I close several loans a month with this strategy. And basically, what is a fix and flip? Is basically a property that you're buying, you're renovating, and you're selling, or you're buying, you're renovating, and you're refinancing if you want to start building a portfolio of properties for rental. Okay, it's important to know that this type of investment provides rapid appreciation. Okay, value increases after renovation substantially for the most part, and during in the short term, it does not require to hold the property. So this type of investment strategy is typically used for properties that need renovation. They benefit immediately from income from the sale, quickly generating capital, and can be strategically used to build rental portfolio, as I mentioned. Okay, it is very common used this way, especially with the burst strategy that you're maybe familiar with. Financing on this type of investment strategy could be up to 93%, depending on your experience and how many transactions you have completed in the last 2 years. I have different financing strategies on this. I'm going to speak about a little bit more ahead. But the great financing options here for the fix and flip is that you can finance up to 93% of the purchase price, and you can finance included in the loan up to 100% of the renovation cost. It is a game changer because it allows you to come into the table with less money. Many people start typically using only their capital to invest in fix and flip and not necessarily take advantage of the right type of financing like a fix and flip loan like I offer. And that allows you to invest with a lower level of risk and maximize your profit. It also gives you faster closing times. Typically, we can close between 7 to 10 business days. Okay, what are the most common mistakes typically done in this particular type of investment strategy? Well, misunderstanding on the renovation costs, misunderestimating renovation costs, and project timelines. Really important because it reduces your real profit at the end, right? So it's important to estimate the cost and take into account possible, non-knowns in case they happen. You might come into the property and say, well, I'm going to spend $50,000. And then during the project, you did not account that the HVAC needs repair, for example, and that could be another $7,000. So let's always try to estimate the renovation cost as accurate as possible. Make sure you're using a good GC or subcontractor that is helping you with that process. And also stay within project timelines, because the longer the renovation goes, the more money is going to cost you during the loan, right? So this is a temporary loan, not meant to be for a long time. Also, that's the other second error, most common error that clients, first-time investors make, is using the inadequate long-term financing for a fix and flip or in this type of investment. Definitely, this is a major mistake and typically start costing you money after a few months. And sometimes you may have to make a decision to sell the property before you're even ready, having, incur losses into the process. So this is some of the information here on the fix and flip. Now, for rental properties, okay, for long-term rentals, I'm not going to spend too much time on this because most people are familiar with what a long-term rental is. But it is important to know that the long-term rental strategy is very active right now, because if the properties are not selling and people are not buying homes, they have to rent somewhere, right? So especially with the new bill that just passed, it incentivizes investors to keep the properties for at least a year and before they sell, and take advantage of all the incentives that are being offered with tax credits. But real quick, for rental properties, they appreciate over the long period of time. Okay, they typically can provide cash flow on a regular basis. And most of the time, it covers all your expenses, principal, interest, taxes, and insurance, and it can give you a regular cash flow every month. And like I mentioned, it does have a lot of tax benefits and deductions, depreciation, mortgage interest, and maintenance that you can claim on a yearly basis. And if you do have an operating business that you do have to incur paying taxes every year, this could be a way to how to help compensate that as well. Most common mistakes that are happening in this type of investment strategy is failing to consider hidden expense like maintenance, vacancies, very big one. In case you have a tenant that leaves you, typically you're going to incur at least 30-day vacancy in the property just to get it ready for your next tenant. And most people don't plan for that. The wrong kind of insurance. Make sure you have the right type of insurance for tenant properties if you do decide to go long-term rental properties. And also the financing of these properties. Whenever you are going to buy a long-term rental property, you want to have the right long-term financing structure in place up front. If you get your own private money or you get your own capital or private lending, that's okay. But remember that those are not really long-term financing strategies for a long-term rental, and it could put you in a liquidity crisis. It may have to sell the property or refinance the property later down the road. Not an optimal condition, optimal situation, costing you more money. So that's what I would say there. For short-term rentals, the famous Airbnbs, I managed a lot of properties, Airbnbs in the past, and I like this model a lot. It is not a model for everyone, but if you are into adding Airbnb to your portfolio, it is a really good cash flow move. This is a temporary rental investment option, and typically you're going to manage them through different platforms like Airbnb, Booking.com, etc. It does provide higher monthly cash flow than a long-term rental. You can still utilize the same structure of the long-term rental for the short term. However, you're really playing here more of a cash flow move than a higher appreciation, right? A quicker appreciation. But you can still get long-term financing in place for this property so you can cash flow further and more. And it also benefits you the same way if you keep the properties as a long-term rental with your tax advantages and discounts. Typically, most common mistakes happen here: ignoring local regulations and seasonality that affects the occupancy and the profitability of the property. When I do a financing analysis for an Airbnb or a short-term rental property, typically I look at the occupancy on the area, the profitability of the property, and some of these things already for you. So it takes the a little bit of the risk out of the investment. I finance a lot of this type of short-term rental properties all the time, and it really depends on the area where you're in and what kind of strategy you want to follow. But definitely, using the financing that doesn't account for temporary rental income is a mistake. Excuse me. And instead of programs that value your real monthly flow, not only we use the value of the property, but also your short-term rental income to qualify for that loan, not your long-term rental income. So it's really important for that. Okay. Excuse me. Multifamily properties. Well, these are typical properties that can go up to 2 to 4 units for residential financing. These are ideal for first-time investors that are just getting started. Maybe they already have several single properties, single traditional properties, and they want to start investing into adding more doors. 2 to 4 is usually a good way to start out. You can actually be a first-time home buyer buying a multifamily up to 4 units. I do that type of financing all the time, and most people don't know about it. But if you are an investor and you already own your own primary house, I can finance you the multifamily properties, not just 2 to 4 units, but also 10 units or more, or 50 units or more. And depending on the size of the units and the transition into residential financing or semi-commercial financing or more large-scale commercial financing, depending if it's 50 units or more. Why are this good to know? Well, because it is really a scalable investment. Once you start getting to several properties in your portfolio, you want to scale faster. Multifamily allows you to do so. It gives you higher positive cash flow, easier, more effective, efficient management, property management, and economies of scale. Okay, it also helps lowers your risk. Instead of having several individual properties that you're managing individually, if a tenant leaves you, then you are 100% unoccupied. In a multifamily, if you have, let's say, a 4 unit multifamily, if you have a tenant that leaves you, you still have 3 other tenants paying you rent, and it lowers your risk of vacancy, and it also increases your cash flow. Excuse me. So what are the most common mistakes that happen with this type of investment strategy? Is underestimating the shared maintenance expenses. You're typically going to share one roof, one parking, common areas, and that reduces your cash flow if you don't really account for those maintenance expenses or you know type of structure, right? Because if your parking is limited, then probably it's going to limit you as far as how many people you can put per unit. So it is important to take all those things in consideration. The second main mistake that most of the clients, first-time investors, do in this type of investment is using basic residential financing instead of specialized product financing for multifamily. That optimizes your profitability and allows you to scale. And what does that mean? Well, a lot of people use a residential loan using their personal income for multifamilies at first, and that's perfectly okay when you're getting started, but that's not needed anymore. There are specific multifamily property financing that I have available that would allow you to not just refinance easier later down the road as the value of the property increases, as after you have made renovations into the property without having to incur additional costs of refinancing, for example. That's just one of the examples that I mentioned. Also, depending how many units property it is, we can go to commercial financing instead of residential financing. So it is much easier to qualify, and it allows you for a better structure and increases your cash flow monthly. So the next option for in real estate investment is actually a very popular one that I'm doing right now for many of my clients in multiple states, and that's new construction. So what does this refers to? When you're building to sell or you're building to rent. Okay, so this type of options for investment allows you to create your own inventory. Okay, so basically, if you're in a market where it allows you to um, take advantage of these opportunities in this moment, okay, either to sell or to rent, be it a traditional single family home, or if you're looking to build a multifamily for rent, for example, this is a very good option. And you don't need personal, debt to income ratio. You don't need taxes, personal income taxes to qualify for a new construction loan. It's actually, I'm going to speak about different kind of options in a moment, but this provides you greater control over the cost, the designs, and the standards of the property. And what do I mean by this? If you're going to sell it, you can design it and control the cost yourself up front instead of buying and renovating into an existing market. So you can basically create your own inventory. If you're constructing to rent, well, you can create the different standards specifically for rental right away. Let's say you're building a duplex or you're building a multifamily up front. The permits and the construction, are very strong initially, okay, because you're going to have the permits, and the initial capital to get started. But we can finance the difference. Once you evaluate the cost and the delivery times, the financing can be put together fairly quickly within 2 to 4 weeks. What are the common mistakes that happen in this type of investment? Well, it's incorrectly calculating the cost overruns and the delays due to the permits, the materials, the labor, which reduces the expected time of completion and your profitability. Okay, so again, using traditional finance instead of a specific construction product financing is a mistake, because then that you're not going to get the funds you may need to complete the products if you're using your own funds to complete the construction process, and your project may get delayed or may get stuck. And that's where you see a lot of projects in the market that are sold either before they finish renovation or before they finish construction, because typically they did not get the right type of financing up front. Typically, when I finance new construction loans, we already take in consideration not only cost of construction, okay, but also cost overruns. So it allows you to get the project started and finished. Um, but this is a very good strategic investment. Depending in the area where you're located, it could be a good strategy to sell, or it could be a good strategy to rent. The great thing is, if you're building to rent, you already know your inventory. You're creating your own inventory in the rental market. If you're keeping it, it could be also constructed for long-term rental, or it could be constructed specifically for short-term rental like Airbnb. And that's a great popular strategy right now, especially because you don't have limitations. You can design the property specifically with the features that you like to separate your properties from other properties in the area. Um, well, I'm going to pause here for a second. I know we covered a lot of information, but you might be questioning which strategy is ideal for you. Okay, that's really going to depend on your experience. It's going to depend on your strategy for investment, your liquidity, and obviously the financing that you're going to be able to get approved for. All right, the key here is to act strategically, get the right advice, take advantage of the opportunities that are going to be presenting right now in the market and that are already here. And the goal today is to kind of give you awareness as far as the different kind of investment options that I work with and the financing options that are coming up next here in a moment. And for more information, obviously at the end you can ask your questions or contact me for a free consult, and we'll create a strategy that is specifically for you. Well, I want to talk specifically about the different types of financing for these types of investment options. Okay. For the fix and flip in particular, okay, you could get up to 100% financing on the purchase, depending again on experience, depending on your capacity and your personal profile. But typically, on fix and flip loans, we can typically see up to 93% is about standard of the purchase price, and up to 100% of the rehab covered in the same loan. So that lowers your amount of risk. Typically, this loan starts about $100,000 or more in total loans. They have a term up to 12 to 24 months. It could be lower depending on the strategy for that property, if it's sell or rent. Now, for new construction, you can finance up to 85% of the cost of the construction, again, depending on the profile, experience, etc., and 75% of the completed value. So Remember that in construction, we go based on cost of construction, not necessarily what the property is going to be valued at after construction. For the construction loan, the loan is going to be given on based on the construction cost. Depending on where you're located, the property's terms that for these loans can vary anywhere from 18 to 36 months. These are typically interest-only loans, and the construction draws are given to you based on how many draws are preset during the financing. Then for multifamily, typically for multifamily properties, you can finance it up to 80% of the purchase price or up to 75% cash out refi if you already own one that you're looking to refinance. This loan is based on rental income only and property value. None of these loans require tax returns. Many of these loans don't even require credit score. If it's in fix and flip, for example, it could be done via hard money or private money programs that I offer. So each particular scenario is different, and each scenario for financing is different. Besides those programs that are the most common, I do offer rental loan programs as well. So what does this mean? If you're buying a property that does not need renovation or that you're not building, it's already existing, we can purchase it with minimum 15% down. Okay, again, depending on the credit profile, depending on the specific property. Typically, these loans are 100,000 to 3 million, minimum 680 credit score or more, but I can go down to 620. There are other statement programs available that I have with 10% down, depending if it's an investment property, a primary property, etc. And again, none of these programs require personal income. None of these programs require tax returns, none of that. And then the equity access, you can actually obtain up to 85% of your home equity in your primary house or in an investment or secondary home. Again, without personal income, without tax returns as well. So these are some of the alternative financing options, additional to the ones that I mentioned before for fix and flip, short-term, long-term rentals, and new construction. I'm going to speak about one question that I get all the time is about where do I find these properties on and off market deals, okay, or deals specifically. Well, it really is going to depend on your area, but I work a lot with great agents in different regions that specialize in some of these options for real estate investment, be it fix and flip, be it new construction, multifamily, okay, or short-term or long-term rentals. So the best really is to, get connected with the right agents or the right networks that helps you uncover some of these deals or what makes more sense for you. Again, we can do a consultation and try to see what strategy works best for you. And if you need help with, finding some of these deals, we can create a strategy for you and connect you with the right person to help you, be it a fix and flip, be it rental property, or be a more passive investment as well, or new construction. These are some of the examples, some recent cases and older cases. I actually have to update this a little bit. We've done many deals since, but this is a property that was just recently closed as well. This is a fix and flip in Sugar Hill, Georgia. Okay, it was purchased for $235, renovation about $70,000. Total investment with purchase was $305, and including the sales commission for the agent, 6% of $25,000. The profit left after financing costs and everything was about $89,000 just in this property. So it was a very good deal. It was financed with Tony Valdes loans. This is a duplex that was also purchased. This was purchased for rental purposes. That was also financed in Georgia, in Forest Park. Very high appreciation after renovation, about $75,000, and monthly rent of $3,000 for a client. And this is an example of a multifamily that was purchased also as a rental for $730,000. This is a fourplex, a quadruplex. So basically, was purchased with the intent for cash flow. After finance, the property was, including taxes, insurance, and all costs monthly, 4,980, and the property rents for 6,600. So it cash flows over 1,700, and it has a 30-year loan, permanent rate financing in there as well. So, well, I'm going to pause here for a second. If you all have any questions, please raise your hand or send or write it in the chat, and I'll be able to answer. Um, Let me know if you have any questions. I know we cover a lot of information, but the purpose for today is really provide, general overview of all the different kind of investments that we have available. This is just the top five of many different types of investment, and also the right type of financing for each. So as we prepare going into 2026, and you're looking to maybe, re-strategize your strategies going into 2026, it's also important to help to diversify your idea of investing and understand the different kinds of financing that you have available for your um, options, okay, for your investments, and not get married with just either your own cash and get into a liquidity crisis, or get the wrong type of financing that doesn't help you. So if you have any questions, please text it in the chat, and I'll be more than happy to answer it. And if you want to do a consult directly with me, just call me, or write to us in our Instagram or Facebook, and I'll be more than happy to do a quick consult individual for your strategy and answer all of your questions. I'm gonna give it about 20 seconds here, 30 seconds, read out a couple of questions, and I know we're 40 minutes into it, so I don't want to take too much of your time on a Thursday. All righty. All right. Hello, Andres. Thank you for joining. Um, okay. Okay. I got a question over here. So Tony, how much do I need to get started with the fix and flip for investment? Okay, that's a very typical question that I receive. So thank you for that question, Johnny. So basically, it's really going to depend on your profile. It's going to depend on your strategy for investing. Okay, I always say, depending in the area where you're located. If you're located in Florida, you're located in Georgia, typically different kind of minimum investments and what kind of property you're going to look at to buy as your first investment. I typically say if you're located in Georgia, I would typically say somewhere between 50 and 80,000 was a good number. It will give you a good option of investment to find for flip, or if you want to buy, rehab and refinance and cash out and then go buy your second flip, for example. If you're in Florida, that's going to look a little bit more like probably 80 to $100,000. Properties are typically a little bit more expensive. Plus, you're going to have some additional higher costs there in that area as well, just because of the location. But it really depends. And if you don't have all the funds, that you don't have to necessarily go at it alone. I get a lot of first-time investors that go in together, and they split capital, they split risk, and that's usually a very good way to get started. But that's what I would say. I have another question here for new construction. Well, yes, for new construction, you can get started without experience. However, one really important thing here to know about new construction investing is if you don't have experience building a new construction property before, be it residential or commercial, your general contractor that is going to get the permit and build that property needs to at least have it. So minimum 2 to 3 transactions that are similar to your investment in the last 2 years for that general contractor. So That's really the most important thing for financing on new construction. But it's very profitable. And new construction could be very profitable if it's planned properly. And looking again, depending where you're located in the area, it could be a great strategy to buy to sell or to buy to rent. Okay, and typically that property as well for residential properties or multifamilies. And that would also help you cash flow for much more on that deal. In a lot of cases, if you have equity, we can cash out equity out of there as well. So great question. Um, so what kind of credit score do I need for a fix and flip? Okay, great, good question. So basically, if you're going to get started with a fix and flip loan, I can do it with no credit at all. But obviously, your terms could change. If you have great credit score or good credit score or okay credit score, that's always going to give you more financing terms options. And what does that mean? Not just the interest rate, because really interest rate here is not that important. The deal itself is important, right? What you're buying it, how much is it going to take renovation, and then what you're going to sell it or you're going to refinance it after. Yes, that's really the most important thing because this is a temporary loan. The fix and flip is a temporary loan, but a credit score, I would say, preferably if you want to have a 680 or higher, would be a good starting point. If you have it 700, 720 or higher, obviously even better. But at least 680 is typical standard in the industry. I can go down as low as 620. And like I said, even if you don't have credit score available or because you're building your credit score, your new credit, or you have bad credit, it doesn't matter. I can still finance it for you. The only difference is that your terms will probably change a little bit from the highest option of financing to a little bit lower, but you can still get 100% of the renovation cost built into it. So that is, hopefully that answers your question there. Hold on a second here, Elliot. Thank you, Elliot, for the question. Do you recommend paying extra for permitted contractor permits on fix and flips? Does permit increases the value? Without permits, is there any risk of having walls ripped out? Great question, Elliot, and I think you have a lot of experience with this already, getting started. Honestly, for a fix and flip, it's not going to give you a higher value for the property if you get permits or you don't. Okay. As a matter of fact, most of my clients don't get permits for their renovations on their fix and flips. Okay. Now, if you're doing a fix and flip in an area that is a hard area with inspectors, or you're doing a major structural renovation or something like that, will it make sense to get permits? Yes, possibly. Just because it's not going to delay your completion time, which again, time of completion is important because that goes to your bottom line. It costs you more money the longer you keep the property in renovation mode. The purpose is to buy the property, renovate quickly within 2 months maximum, okay, and move to sell or move to rent. If you're taking, 4 to 6 months in a renovation, it defeats the purpose of a fix and flip, in my opinion, in a lot of cases. So you want to get a good. We talked about this many times in the past, and the past webinars. Want to be within 60 to 90 days maximum on the renovation. But adding permits or not adding it doesn't add any more value to the property. Without the permits, is there any risk of having walls? Yeah, there's always a risk involved. My advice is usually get a good contract with the contractor or the subcontractor that can protect you from some of these things that might come up. But not having permit is not necessarily a negative. Thank you, Luisa. I have another question here. Which investment strategy you think works best in today's market? Great question. Long-term rental, short-term rental, fix and flip, and why? Okay, I'm gonna say this. I think all the strategies could work depending on the scenario, right? I think you need to be ready for multiple strategies at least, and depending on the opportunities that present to you, be it fix and flip or be it a short-term or a long-term, then you can take advantage of that. And that's what we do. We prepare our clients not just with the right type of financing, but understanding what are the differences of those different types of investment. So if you do get the opportunity for one of those, you're ready, either with the financing or with the strategy. You know what kind of capital is going to take, what risks are involved, and lowering those amount of risk. That's really what investing is. Is maximum profit at the lowest level of risk. And you know, I can help you guide you through that process. So thank you for that question. It's a great question. So many of my clients start doing fix and flip, and then eventually start creating a portfolio of rental properties, either short term or long term. And that's going to depend on the opportunities that come up with the properties itself. Or you can specifically go into the market and buy for certain properties, for example, multifamilies or short term rentals. Or you can specifically target new construction. And it's really going to depend doing a market analysis of the opportunities that you have, and what's going to make more sense for you. Get the right type of financing, you know, maintain lower risk possible, but also always with multi-exit strategies. No matter if you're doing fix and flip, no matter if you're trying to just do new construction or you're doing you know, rentals. When you buy in real estate investing, you need to buy at least with option A and option B. Okay, so if you buy fix and flip, yeah, if you're planning to sell it, but if you can't sell it, well, you need to have an exit strategy for option B. What are you going to do with that property if you can't sell it? Well, we need to have already preparations of refinancing that property and turning it into a long-term rental or a short-term rental, at least for the time being, to buy you time until the market changes, or maybe it makes more sense switching it into a rental property for you specifically. And that's going to depend on your profile, your level of risk, and your capacity. But that's something that I teach to my clients from the very beginning, before you even start looking for a property. Because when you buy with that strategy, you're lowering your level of risk, and you're obviously going to increase your level of profit by doing so. And that includes the right kind of financing. So I work together with your real estate agents as a team, and we come out with the right strategy to make sure that, you know, that we keep you healthy, safe.